Hello everyone. In this video today, we're going to be going through the topic of sales tax payable and then income taxes payable. So basically, first to start off, what is sales tax payable? Well, it's a current liability a company records when it makes a sale. Okay, companies collect sales tax from customers and then they remit the tax to the proper governmental authority. Okay, so basically, when recording the tax, the company may take two different approaches. Okay, the first approach is that they may debit cash for the sales price plus the amount of the tax, credit sales revenue for the sales price of whatever item they've sold, and then credit sales tax payable for the amount of the tax. Okay, so that's approach number one. Approach number two is they can debit cash and then credit sales revenue for the full sales price plus the amount of the tax. Okay, now this approach requires an adjusting entry later on. Okay, we're going to see a quick problem of this in just a minute. We just have to go through income taxes payable relatively quickly. This is a very quick one. Sales tax payable relatively quick. We'll see both methods of this in just a minute and what that means. But again, sales tax payable, I'm sure that we're all relatively familiar with sales tax, right? When you buy something, you pay sales tax, and the company itself collects the money and then remits it to the government. Okay, that's basically what we need to know about sales tax. Income tax payable is a current liability a company records based on the amount of income the company earns during the year. Okay, so basically corporations must pay income taxes on a quarterly basis, and to determine a company's income tax liability, a company multiplies its tax rate by its income for the year. Okay, so let's say XYZ company makes $100,000 during 2017, its tax rate is 30%, well then its tax liability would be $30,000. Okay, so basically that's the extent of what you would need to know, okay, for income tax payable. It's a relatively quick topic for this class. Okay, the only other thing they could say is make the journal entry here, and the journal entry would just be income tax expense for $30,000 as a debit, and then income tax payable for $30,000. That would be the credit. Okay, that's all you would really potentially have to know. Okay, so then let's look at a quick example of the sales tax payable using approaches 1 and 2. Let's just get these both side by side, make sure we can see both of them. Okay, they look like they're both in the field of view. So example 1 is going to be sales tax approach 1. Example 2 is just going to be approach number 2. So on January 2nd, ABC company sells a can of soda for $1 to a customer. The sales tax for the county that it operates in is 7%. Prepare the journal entry to record the sale and the associated liability, assuming that the company uses approach number 1. So approach number 1 says we debit cash for the full sales price plus the amount of the tax. Okay, so the sales price is $1 and the tax is 7% of $1, which is 7 cents. Okay, so we debit cash for the sales price plus the tax. We credit sales revenue for the full sales price. Okay, so that's $1 to sales revenue. And then we credit sales tax payable for the amount of the tax. That's 7 cents. Okay, that's approach number 1. Okay, approach number 2, same facts. Now we just have to make the journal entry on January 2nd, but then additionally it says prepared adjusting entry dated January 31 of 2017, necessary to record the sales tax liability. Like it says here, under approach 2, we need an adjusting entry later on, okay? And we'll see why in just a second. Approach 2 says debit cash and credit sales revenue for the full sales price plus the amount of the tax. Okay, so the sales price plus the amount of the tax is $1.07. Okay, so we debit cash and we credit sales revenue for $1.07. If we were to compare that to above, we can clearly see we don't have the same results. We have overstated sales revenue and understated liabilities. Okay, so then we need to prepare an adjusting entry. The adjusting entry is going to be to debit sales revenue to decrease it and to credit the sales tax payable to increase it. Okay, so now we can compare and make sure we have the same thing. Cash is debited for $1.07. Sales revenue is debited for $1 here. Credited for $1 here. It's credited for $1.07 here and then debited for 7 cents, which means that it's a net credit of $1. Then sales tax payable is credited for 7 cents. Sales tax payable is credited for 7 cents. Okay, so all the accounts work out to be the same thing. This is a basic example. Obviously, you could have bigger numbers or different numbers or whatever, but this is basically what you need to know about sales tax payable, and then income tax payable we went over. So that's the end of this video, and I hope that helps.